And I think tonight you're going to really see for those of you who are taking this for the first time, you really start to see the gel coming together, because you're going to start to understand why I went through all those kind of basics in the last class. And for some of you, Jason Smith, you in particular, and a couple others who were asking about collars, what I'm going to lay the foundation for tonight is basically the collar strategy, period. We're going to, this whole thing that I'm going to teach you is a collar. And you have the choice, do you want to do it with a stock position or with a leaps position? Other than that, it's identical. That's literally it. You just make one choice. If I were to put this 4-class series together for collars, it would be identical. It would literally be the same thing, except for about halfway through tonight's class, I'm going to make a pivot and move into leaps. And you could just stop right there, and then you've got the collar training. It's all the same. So that's something to keep in mind as we go through the evening. And then, when we get to class 4 and we talk a little bit more about making this strategy yours, as we went through the mastermind group together, a lot of our students said, hey, you know what? The calendar spreads, it takes more management than I want. And some of those people said at the end of the day, they really feel like they're more of a covered call and collar trader. And that's fine. It's totally fine. There's not a right or wrong here. These are all just different strategies that you can have in your quiver, and you can pull out different arrows at different times. Some of you said, well, if I wanted to do collars, how much should I spend on the stock? And the answer is however much you want to. I mean, you're going to get a little bit better ROI if the stock is a little less expensive. For example, a $40 stock, writing covered calls on that is going to give you a little bit better ROI than a $500 stock. It's hard to make the same income on an option premium for a $500 stock. It just is, but it's still there, and you can still do it. So there's really not a right or a wrong. You just have to remember some of the limitations. But the actual strategy and the technique is essentially the exact same thing here. So just keep that in mind as we go through it. And I'm specifically addressing some questions from Jason, and I think a couple others had asked as well. Some of you need an email, or you need a notebook. A crud muffin. I did not pull out the notebook for you. Hold on a second here. All right. Talk amongst yourselves. Let me look up the notebook and pull that out for you. I should have done that. Where are you? Blah, blah, blah. Got too many windows open over here. No, that's not it. But this will work here. I'm just right there. All right. So I'm working in the background. You guys are talking amongst yourselves. And boy, exciting day yesterday, wasn't it? Nice big bullish day, 500 points. I don't know who would have ever prepared you to think that the market might go up 500 points in a couple of days. Can you imagine anybody would have had that kind of foresight? Maybe like on a Sunday night, do a better job of getting that out there for you. Look, guys, I'm getting old. I'm just not as sharp as I used to be. I mean, once you hit 40, who figured that out? When you hit 40, things just don't go as quickly as they used to go. It's kind of cray-cray. Cray-cray. Those of you who are less than 40, all 10 of you, be warned. When you hit 40, everything goes downhill. It's horrible. But I started hearing about, have you heard about these telomeres? I'm going to try it. There's a product that I was just listening to some reviews on, watching some videos. It's called Vitalometry. And it takes these the telomeres on your DNA, and it like regrows them. And this guy I was listening to talk about it, like his hair went from gray back to black, and he started to regrow hair, and maybe in places he didn't want. I don't know, but anyway, I thought that was kind of interesting. And since I could use some hair growth in places that I do want, that would be good. And I got some grays coming in, which is a little bit scary. And other things that these telomeres do, just basically it reverses aging. Really cool. So I thought it sounded pretty interesting. So I'll spend the money on your behalf. I will buy one, get one free, because that was the offer I was listening to. I will buy one, get one free. I will take the pills for a couple of weeks, and then I'll let you know how it works out. How's that work? All right. Let's jump in here. I think we got we've gained about 30 people since I started talking here. Let's jump into class number 2, monthly income with spreads. And here's what we're going to talk about tonight. We're going to talk about the covered call. We're going to talk about the poor man's covered call. And then we're going to boil it down to weekly and monthly income and calculating your ROI and your cash flow. This is the most important, well, it's not the most important lesson of the group, but of these 4 classes, this one lays the core position. So you're going to want to understand this one, and let's do it. Let's do a quick 30-second review here. Last class, we talked about various spread variations that we can deal with. We talked about vertical spreads, calendar spreads, and diagonal spreads. Verticals, calendars, and diagonal spreads. All of these spreads involve two legs, both a long and a short leg of the option, but across the bottom two rows here, you see the differences. Vertical spreads are same expiration, different strike price. Calendar spreads, different expiration, same strike price. Diagonal spreads, different expiration and different strike prices. All right, now let's talk about leaps. We learned what leaps are. Who can tell me what a leap is? It's on the screen. Long-term equity anticipation security. We discussed what a horrible acronym that is. Anyway, what is it? It's really just an option with a long time to expiration, 9 months or more to expiration. That's a leaps option. Works just like a regular option. When it's less than 9 months, it just turns into a regular option. Nothing changes, just less time to it. And we've got leaps for both calls and puts. You say, well, what's the benefit of the leaps? Well, long-term option means you have control for a long time. You've got long-term control with a call option that gives you control to buy, the right to buy for a long time. Puts gives you the right to sell for a long time. And of course, you can use the calls as a replacement for buying stock, and you can use the puts as a replacement for shorting stock. And of course, my example that I used in the last class was instead of buying the QQQ for $180 a share, you could buy the leaps for the January 2020 180 call. And now you've got control of QQQ for, according to this chart, about 18 months into the future. That's the benefit of using a leaps option. That's my quick review from the last class. Any questions of the last class before we move forward? You have exactly 19 seconds to tell me any questions you've got. I'm going to drink a little bit of my high-quality hydration, which is not Dr. Pepper, because my blood pressure is going up. My wife told me that if I died, she'd kill me. So this is actually like electrolytes, and it doesn't taste nearly as good as Dr. Pepper. If we could get like Gatorade flavored Dr. Pepper, that would be awesome. Or I said that backwards. Dr. Pepper flavored Gatorade. That'd be great. Anyway, covered calls. Let's jump in here. Oh, wait. I did have a question. Okay. This comes from George. Is a leap like a buy and hold? Sort of, George. In many ways, George, yes. But the issue is you have to eventually, well, you don't have to, but eventually you're going to want to sell the position. But yes, George, you're going to use a leaps position when you want to have control for a longer period of time. If you just want to have control for, a couple weeks, there's no reason to pay the extra money for the leaps position. And it's not going to move as fast. So you want to, it's going to be more of a buy and hold or more of a position trading, if that's what your question is. Yes. All right. Let's talk about covered calls. How many of you have placed covered calls in your real trading account? Anybody? How many of you have done this? If you've never placed a covered call, you really owe it to yourself to do this. Very simple strategy. And it should be a basic strategy that's in everybody's back pocket. You should all know how to place a covered call. Basically, a covered call is a compound option strategy, involves both buying the stock and selling the option. You may do it at the same time or you may do it at different times. I typically buy the stock position when I do covered calls. I don't usually do covered calls, but when I do, I will buy the stock position and then I turn around and sell the call option either fairly quickly or sometimes at a later date. Just kind of depends on the positioning. I do this, me personally, just giving you some transparency here. When I do a covered call, for example, I'm in one right now. And the reason I'm in that particular trade as a covered call instead of options is because there's not very much option liquidity. So I couldn't do it with the leaps. I could have. I just chose not to because I wanted to have better liquidity. So that's a reason where you may choose to do the covered call instead of the leaps trade if liquidity is an issue on the stock position that you're trading. Yeah, so that's the issue right there. So if you're dealing with something where you're going to have 2 or 3 open interests, you're not going to have very much liquidity. It's hard to get in and hard to get out. And so in a case like that, I would definitely lean towards buying the stock and doing the covered call. So there you have it. And when I do that, what I do is basically everything else that I'm teaching for the calendar spread, I just do it with the stock. And it's a covered call / a collar position when we're done with that. When you buy a long stock, this is your risk profile. Stock goes up, you make money. Stock goes down, you lose money. You own part of the company. You receive dividends if they're paid. You're looking for a capital gain. That is, you're looking for the stock to go up. Your ownership will not stop unless you sell the stock. All of you understand that. Why? Because all of you have bought stock before. So, for example, if you buy SPY, what is SPY? It's S&P 500, right? You buy the S&P 500, if the market goes up as a whole, the SPY goes up, make money, market goes down, you're going to lose some money. Everybody understands that. That's the first part of the position. Now, the next thing is, now that you own the stock, now that we own it, why not go sell some calls against it? Well, what happens when we sell a call option? Well, when you sell a call option, in and of itself, is it a bullish or bearish strategy? Somebody tell me. Bullish or a bearish strategy in and of itself? Which one? Selling call options, not covered calls, but selling calls. Is it bullish or bearish? Nobody? Jason says bearish. And Linda says bearish. Fantastic, Linda. George said bullish. All right, let's look at the risk profile here. If the stock goes up, you lose money. If the stock goes down, you make money. Is it a bullish or a bearish strategy? It's a bearish strategy. Fantastic. When you sell a call option, you're selling somebody else the right to buy the stock. You become obligated to sell at that price. If necessary, you're looking to capture the time decay. You need the stock to go down for that to come to fruition. You're wanting to capture all that time decay that we talked about in the last class. So this is an actual theta chart right here that you're looking at. This is a time decay over 3 months. Across the bottom, you see the option pricing. Now, as you get closer and closer to expiration, what happens to the option value? It's going to go down in value. You're going to notice, though, right at the end of that option curve, starting around the 29th here, this is where the theta starts to really kick in. You see how much faster it kicks in? That's why most of the time, whenever you're dealing with shorting options, you want to deal with those last 2 or 3 weeks to expiration. That's where you get the fastest time decay relative to the money or the premium that you receive in the trade. All right, so if you short a call, here's what happens. You make money up front. You get paid up front. You make money, the stock goes down. You make money, the stock stays the same price. You have unlimited risk if the stock goes up. How is that? Well, if the stock goes up, you are obligated to do what? You're obligated to sell. Somebody else had the right to buy it. You're obligated to sell it. So the stock comes up to 285 and you sold somebody a 275 call option. You're obligated to sell at 275. I don't have the stock. What do? I got to go buy it. So now you got to go buy it at 285 and sell it at 275. And that's how we lost $10 on the trade. That's why when you short call options, you want the stock price to go down. This is considered a naked or an uncovered call, the way that I have laid it out on the screen here. Now, what happens if you don't want to be uncovered? Could it be that before we get into this trade, we cover ourselves by buying the stock on the front end? So if you buy the stock on the front end for, say, $272.90, and now you sell a 275 call, well, if you get called out, it's not a big deal, right? Because you already own the stock. When we do that, we call it a covered call. You're selling a call option on a stock that you already own. And look at the risk profile. The risk profile changes. Now it's no longer a bearish strategy. What kind of strategy is it, Richard Karasik? Now that we've bought the stock, if the stock goes down, you're going to lose money. If the stock goes up, we're going to make money. If we sell the covered call, we've limited our upside potential, but we're still going to make money only if the stock stays the same price or goes up. So, Richard, what kind of a strategy is it? And he says it is a bullish strategy. And I'm calling Richard out because as smart as Richard is, and he's honestly one of the smartest guys here, he's been watching my classes for years, and I think he's done a bunch of these covered calls, but he sent me an email, and he was like, hey, you wrote that this was a bullish strategy, and it's a bearish strategy. Nope, it's not, because it's bullish because of that underlying stock position. The underlying stock position makes this a bullish strategy. If the stock goes down, then you're going to lose intrinsic value or you're going to lose equity on it, which means you need the stock to stay the same price or to go up a little bit to reach maximum profitability in the trade. So yes, it is a bullish/neutral strategy, and it's become it's a covered call. Remember in the last slide that you saw just a couple slides ago, if it's a naked call, it's a bearish strategy. Now that it's become a covered call, it became a bullish strategy. You see the difference? It's what we talked about in the last class. Every time we try to offset one risk, we add a new position in there. And what happens? We change all of the strategic outflow of that strategy. So now if the stock goes down, we have risk. We own the stock. And if the stock goes down, we lose equity on it. If the stock goes up, we're covered, but we've limited our income potential. Now, here's the thing about the covered call. You cannot lose more money than you originally put at risk. You cannot lose more money than you originally put at risk. And you're guaranteed to receive the option premium. That doesn't mean you're not going to get called out. You might get called out if you hold the position long enough, but you're still going to receive that option premium. And again, you're not going to risk more money than you originally put at risk. So because of that, a lot of people really gravitate towards this strategy because you're already taking that risk. Why not maximize your income a little bit? Here's some of your key strategic benefits. Number one, you're guaranteed to make your premium. What is one of the only guarantees in the world of stock trading? Guaranteed that option time decay will continue to work against me. Right? Guaranteed. Option time decay will continue to work against me. So if we're selling options, we're guaranteed that option premium will come our way. It's a predictable way to create income. It increases your ROI during a sideways or a bearish market, which is where you were confused just a little bit there, Richard. And that third bullet point right there is why so many people gravitate towards this strategy, because it's a way to create predictable ROI during sideways and bearish markets. But a lot of people confuse the covered call as a bearish strategy or a neutral strategy, when in reality, at its core, it's a neutral to a bullish strategy. Okay? Another benefit is it lowers your cost basis, and of course, you can always close it early, remove your obligation, hold your stock position. Okay? So there's some key strategic benefits. Now let's talk about cool ways to think about the covered call. Number one way is to lower your dollar cost average. That's usually the most popular way people think about it. Number two is to create monthly income. Number three, it's the ultimate dividend. Sort of. Number four is it's a way to beat the S&P every month. So let's talk about these. In fact, I can't remember if I actually did a slide for the ultimate dividend or not, or beating the S&P. So I'll just talk about those really fast. And then if I have a slide coming up, we'll be surprised. The last two bullet points here, the ultimate dividend. When you sell a covered call, you still receive the dividends. If they're paying dividends, you still receive them. So, selling the covered call, you end up making about as much money every month as you would from the dividend. Plus, you can still keep your dividend. That's why I call it the ultimate dividend. And then in terms of beating the S&P, if all you do is buy SPY, all you guys have to do to match the market is buy SPY. If you buy SPY, you're going to match the S&P 500. And then if you sell covered calls on it, you're going to beat the S&P 500. Ding, 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 ding. So it's a way you can beat the S&P 500 every month. Isn't that amazing? But let's talk about lowering dollar cost average and some of these other issues here. So here's the idea. You're going to buy the stock. In this example, we're going to buy the QQQ for $180 a share. How long do we own that for, George? How long, if we buy the stock, how long can we own it? Until February, until December, until April? Forever. That is correct. Once you buy a stock, you own it forever. Until when? Until what happens? Until you sell it, or until they do a stock buyback, or until the company goes out of business, which hopefully that's not going to happen. But yeah, once you buy a stock, you own the stock, right? They're not yanking your ownership away from you left and right here. So when you buy a stock, you own it, and you own it forever. Now that we own the stock, if I come along and I sell, for example, a $183 call option, if the stock goes up and I get called out at 183, do I keep the profit? Yes or yes? Absolutely. So you bought the stock. You buy it at 180. If you get called out at 183, you made a profit on it. Can't go broke making a profit. Plus, you kept your premium. What if you don't get called out at 183? What if you just hold the position? Can you turn around and do it again? The answer is yes. And could you turn around and do it again? And the answer is yes. And can you do it again and again and again? And the answer is yes and yes and yes. In fact, you can do this month after month after month. And this is why we say it's like receiving a monthly dividend, or you could even do it weekly if you wanted to. Because every time you write those options, time decay is working in your favor and money is coming into your trading account. And if you do get called out of it, you already own the stock. So you're not losing money on, I got to be careful how I say this. If you're selling the call option at a higher strike price than you purchased the stock for, you're not losing money. You could lose upside potential. If you sold the call option at a lower price than what you paid for it, then yes, you could lose money on it. But that was a risk that you'd already taken on. So you guys understand what I'm saying on that? You're covered in the position because you already own the stock, so you're not going to end up with an unlimited risk like you would with a short, with a naked call. Okay. Now, how much money could we bring in on this QQQ trade? Well, we spent $180 a share. If we wanted to sell the 183 call option at the time of this particular slideshow, we could bring in about $1.41 per share. Let's lower it. Let's just round it down to $1.40. If, and you can see my math on the right side here, if we sell the option premium for $1.40 and we end up selling the stock at $1.83 or 183, we end up with $3 per share profit plus $1.40. It's $4.40. There's your max profit. Your max ROI on this is 2.4%. Woohoo! Yay! 2.4%. We can do that in one day, right? Not exciting. I get that. However, look on the right side. The exciting thing is not the max profit. The exciting thing is the guaranteed minimum profit, which in this case is $1.40 or 0.7% ROI. Now, again, that's not huge dollars, but if you're buying stock and you're holding it, and by the way, this took 29 days to expiration. If you're buying stock and you're holding it, how much are you expecting to make over the course of the year? Usually, most people are excited to make 8 or 10%. Most people. In fact, last month, what happened? The market went down 10%. Everybody freaks out because it's down 10%. And we lost the whole year's gains. Oh, it was just a tragedy. It was horrible. Right? 10% for most people is an entire year. And here we're doing in 1 month, 2.4%. What if we did 0.7% every month? 0.7% every month. Have you ever thought about those numbers? Take a look at this. If we did 2.4%, which was the maximum, if you did that every month over the course of the year, that would be 29%. So if you theoretically purchased the stock, if you did it with 1,000 shares, let's say you brought in we made $4.40 every time. It'd be $4,400 every month. It'd be $52,000. It'd be 29% ROI. But let's look at the minimum income. This is where it gets really valuable. If you brought in 0.77%, which is $1.40 per share or $1,400 on 1,000 shares, and if you did that every month, it's still 9.24% basically guaranteed income, or $16,000. So the Qs you could buy the stock, you could write a call every month for $1.40 or right about $1.40. And if you get called out, you make 2.4%. If you don't get called out, you still make your 0.7%. If you do that every month, you're going to bring in 9% cash on investment. Can't really argue with that. Now, what if we took a cheaper stock? It works well for the $180 index ETF. But what if we took a cheaper trade like Micron? At this time, Micron was $53. It's gone down a little bit recently. In fact, I just published this as a trade idea in our Traders Club last night, the new positioning on this. But at this time, stock was trading at $53 a share, and we could sell these options for a $55 strike price for $1.49. So just taking a stock that's half the price with a similar premium, look what happens to our ROI. Our maximum ROI turns out to be 6.5%, and our minimum guaranteed ROI is 2.8%. You plug those numbers in and look what happens. Over the course of a year, it's 33% ROI, $17,000. Instead of 9%, 33%. Just by taking a stock that's $55 instead of 180. So Jason, you were asking me questions about the collar. You say, well, which price is better? There's not a better. It's just which one's going to match what you want better. You can do this with a $180 stock. You can do it with a $280 stock. You can do it with a $500 stock. You can do it with a $50 stock. So it doesn't matter which price point it is. What matters is which one works better for the way that you're trading it. Does it make sense, Jason? And part of it's what you can afford. Yeah, you got to do these 100 share increments. All right, so what if we did that and we were thinking about Micron, and what if we brought in 2.8% every month, $1,490, and we used it as a way to lower our cost basis. By the end of the year, our cost basis would be down to $35,000 because you would have brought in $17,000 in premiums. That's one way to think about it, lowering cost basis. What if we thought about it as a reinvestment? What if we, every time we took in some premium, we took in $1,490, what if we used it to acquire new shares at $53 a share? We can buy 28 shares. The next month, we do it again. We buy another 28 shares. Next month, we do it again. You know, right now in the real world, the stock's gone down, so we could buy more than 28, couldn't we? Same premium could buy more than 28. In fact, you're making bigger premiums now because the market's gone down. So you lost a little bit of equity, but you're actually making bigger premiums because I said the market's gone down. The implied volatility has gone up. That's what I meant to say. Well, the market did go down, but implied volatility went up. So you're actually making a bigger premium. Now watch what happens after about 3 or 4 months of that. You end up with enough shares that we can sell 11 contracts instead of 10. Now our premiums went up to $1,600 a month. After about another 3 or 4 months, you got enough shares that you can do 12 contracts. We're up to about $1,788 a month. And on. Now, about every 3 months, we're increasing our number of contracts. After 1 year, just selling covered calls on a stock like Micron, we've acquired enough extra shares to take on 3 additional contracts, and we're bringing in $1,900 a month. Now, I want you guys to stop for a moment here. How many of you don't have to answer publicly necessarily. You're welcome to, but just think about this. How much money do you need to bridge the gap between where you are right now and your retirement income that you need? Some of you are needing an extra $2,000 a month. Some of you are needing an extra $3,000 a month. Just think about it. How much do you need to bridge your gap for your retirement income? And how much capital do you have to work with right now? If you had the $53,000 necessary to acquire this trade position right now, you could start bringing in $1,400 a month. Just let that sink in for a brief moment. If you had the $53,000 necessary to acquire this position, you could bring in at least $1,400 a month. If you didn't need the money, if you just reinvested it and you let yourself take in more shares, and maybe as the stock price went down, you took in even more, and you keep writing the premiums on it, you're up to $1,900 a month. Let's go out another year here. After another 3 or 4 months, you've acquired another 100 shares worth. You keep doing this every 3 or 4 months, you've acquired another 100 shares. Before you know it, it's every couple of months. There goes my dang Apple bug again. Tell you what, if I ever get my hands on the Apple engineers, I guarantee you they're going to put me in jail because I'm going to strangle someone. I'm not really serious. I'm not really going to do that. I just want to from time to time, but I'm constrained, I promise. Anyway, take a look at these numbers here. Following the same logic here, every couple of months now, you're adding enough shares that you can get a whole new contract. Now, by the end of 2 years, you're selling 18 contracts a month instead of 10, and you're bringing in about $2,600 a month. This is a retirement plan for many of you folks. Let that sink in for a brief moment. If you had $53,000 right now, actually, you could do this trade for about $47,000 right now because Micron went down a little bit. Buy 1,000 shares of it, start writing covered calls on it, bringing in the premium. Every month, you're going to have a little extra cash in there. What if you go out another year. Look at this. By the end of 3 years, you've acquired over 2,500 shares, and you're bringing in almost $4,000 a month. How many of you have already seen a number over here, one of these income numbers, that would cover the gap that you have between your current income and what you need to retire? Okay, if you've seen that number, then great. That's how many shares you would need for this particular trade. Let's go out a fourth year. 4 years into this thing, we've acquired enough contracts, 26 contracts, 28 contracts. We get to the point where we're adding almost one per month, and we're bringing in over $5,000 a month in option premiums. And after 4 years, just using this little strategy called a covered call, we would have brought in $54,000 a year in option premiums, and you've built an equity of $188,468. All starting with your 1,000 share position with an average price of 53. Now, of course, if the stock price goes up, these numbers change. Stock price goes down, the numbers kind of change, but they actually would change somewhat in your favor, which is, I think, why Richard had thought about this as a bearish strategy, because you position yourself, you're lowering your cost basis, and if you're taking on new shares, it's actually working in your favor the more it goes down, because you're taking on larger positions. Now, Butch's strategy on this, Butch does this all the time. Many of you know Butch. You hear us talk about Butch. Been trade smart since 2009. I mean, he's been here as long as I have, which is scary because it's my company. But Butch, what he'll do is he'll do the same thing I just laid out for you until he gets to about 10,000 shares. And when he gets to 10,000 shares, he just sits there and writes the cover calls, and that's his retirement income. You get that on a couple of different stocks, and you're sitting pretty. I don't know how he came up with 10,000 as his magic number, but that was his magic number. It's 100 contracts. You don't have to do that many. You could get away with 1,000 shares for some of these stocks, and it gives you the income you need. Some of you need 2,000 or 3,000 shares of a stock. But just look at it. If you had 3,000 shares of a $53 stock, you get about $150,000 in it. You're bringing in $4,000 or $5,000 a month. Not too bad. How many of you see that with this one strategy right here, you can actually retire maybe right now? Like if you had to right now, you could start coming up with a retirement plan. Phil says, don't forget to mention this only works if the stock's trending up. No, that's not true, Phil. That's not true. Actually, if the stock is trending down, you lose equity, but you can actually take on premium, or you can take on positions faster. So in some ways, I don't want to say it doesn't matter, because it does, but if the stock's going down, Phil, you're actually acquiring twice as fast. It's kind of a combination of active trading with dollar cost averaging. So like right now, Phil, let's take this trade right now as we stand in the market. Happen to have it pulled up. Look at that. I did not plan that. But right now, if you look at Micron, current price, I said 47. I was off about $10. It's $40 a share. So, when I did this slideshow a few weeks back, we were at $53 a share. We were up here. Well, we dropped below all those support levels, and we dropped down to the next level. Well, now you could acquire these positions at $40 a share, Phil. But guess what, Phil? You're buying them $13 a share cheaper. So you're buying twice as fast. But if you come in here, Phil, and you start writing premiums, in this case with 9 days to expiration at, 2 or 3 strike prices out, not bringing in much, bringing in 18 cents. Let me get a fair comparison, because we were a month out before. So the December 7th expiration, which is a month out, you go to about the 44 as soon as these numbers come in. Come on, numbers. Update. Let's not embarrass everybody here. You can do it. You can do it. They're coming. I know they're coming. I feel them. We got 2 of the chains left. There we go. All right. Come up here at about $44 a share. You're bringing in 50 cents plus, 50, 60 cents. If you come a little closer, for example, $42 a share, bring in $1.18, $1.22. Let's do the math on that real fast. Okay. If you bring in $1.18 and you spent $40 a share, our ROI on that is 2.9%. So the stock stays the same price or goes down, you're still bringing in your 2.9%. If the stock goes up and you get called out at 42, 42 minus 40 is $2 plus your $1.19. That's $3.19 divided by 40. Let's do my math on it. $7.9 in a month. So Phil, yes, you lose some equity position, but if you're looking at building your long-term gain, you actually kind of want the price to hang out in the lower price range for a little bit. You gain all your positions, then you start selling your calls and hope for your equity to go up over time. You tracking with me here? I think that was Phil. Somebody deleted his question here, but Phil, you tracking with me, bud? I know, I'm making some assumptions here tonight. You guys already understand somewhat of the covered call because I'm not teaching it in great detail. You're welcome, Phil. I've taught this a lot, so I'm kind of assuming most of you already have experienced that. If you need me to slow down on some of it, just let me know. All right, let's talk about the great covered call. Covered calls are great for creating income. And by the way, everything that you learn in the calendar spreads, I just want to really emphasize this. Everything you learn in the calendar spreads, if you get to the end and you say that's too complicated, come back to this right here. Just come back to covered calls, because in its core, this is what we're working with. Covered calls are great for creating income. They're great to help us lower our cost basis, great to use as income to buy more shares. They're relatively safe. They're relatively low maintenance, and frankly, they're kind of fun to do. In other words, it's perfect. This is the absolute perfect strategy, right? Well, sort of. I mean, it's a great strategy. I don't want to say it's not perfect. I don't want to say it is perfect because I don't think there's any strategy that's perfect. If you don't have the capital to do it, it's not perfect for you. If you have the capital to do it, there's a lot of strengths to it. Is it perfect? No. Here's the weaknesses. The first weakness of the covered call is the fact that it requires more capital to execute than a long option position. Now, is that a weakness or is it just a reality? It's just a reality. That's all it is. It's just a fact of the strategy. It takes more capital to do covered calls than to do short-term option trades. The bigger risk and the real risk of covered calls is that you've got the equity risk of the long stock. Now, here's the reality. You already had that. You already had that. If you're trading, I don't know what your account is. Everybody's got a different account, but if you got $100,000, you got $150,000, $200,000, and you're trading long-term positions, you already have equity risk. Last month in October, guess what happened, Phil? Your equity went down unless you stopped out of the trades. Your equity went down because every one of you who's trading stock, you've already got the equity risk. So the benefit of the covered call is that you're creating a way to maximize some profit without taking on new equity risk. Make sense? Now, here's my big red screen disclaimer. The covered call is a relatively safe and relatively easy trade to implement. And if that's all that you learned from this course, you are ahead. However, what I'm about to show you is similar, but it has a lot of moving parts. Please do not mistake the opportunity that I'm about to share with you with a lack of complexity. And everybody who's here tonight who is part of my mastermind, you know this, because that was the first thing that everybody realized is, wow, there's a lot of moving parts. Do not mistake the opportunity with a lack of complexity. please, and I said, please practice this in a virtual account at least once or twice before you place it with real money. Because as everybody who's just spent the last 8 weeks going through this with me can attest, there are moving parts that will surprise you until you experience it. And then once you experience it, you're kind of like, now I see it. Okay. So please practice this in a virtual account before you move on to real money. Now, here's my other warning. Do not tell your friends what I'm about to show you. Samuel, you got that? Don't tell this to your friends. It's going to hurt their heads. Tomorrow at lunch, whenever you sit down with your amigos and your amigas and you say, I sat in the Trade Smart class last night and I learned this amazing strategy. Don't tell them this, because they're going to sit there and they're going to look at you like you're a weirdo, and they're going to be confused, and they're going to say, you can't do that. That can't be legal. They'll accuse you of criminal acts. You might even accuse them of being a part of the opposing political party that you affiliate with. If you're a Republican, you'll say you're a Democrat. If you're a Democrat, you'll say you're a Republican, because they're going to be accusing you of weird stuff. And they're going to ultimately say, no, it's too good to be true. And they might even try to take your dog. I don't know if that's true. I just made that up. And the reason is because it's totally awesome. Are you ready? I'm going to introduce you to the poor man's covered call. The poor man's covered call. Here's my question for you. Are you ready? How can you lower the capital costs of a long stock but maintain control? How can you lower the capital costs of a long stock but maintain control? While I drink my high-quality electrolytes, imagining it tastes like Dr. Pepper, which it does not. Quality lemon-flavored electrolytes. How do we do it? How do we lower the capital cost of a long stock but maintain control? Jason says buy a put. Niall says take a leap. Linda says take a leap of faith. Sell a call, says George. How about we just buy a call? I mean, this is pretty straightforward. How do you get control of the stock without spending the same amount of capital? You buy a call. You just buy a call option. Like, what does a call do? It gives you control of a stock. Remember that? So let's buy a call option. Now, here's the next question. Can we buy a call option that would give us control for a really long time? And Niall says, yes, take the leap of faith. Remember the leaps? Leaps are a long-term call option. So could, for example, we buy a call at 180 with an expiration of January 2020, and would that give us control of QQQ at 180 for a long time? What do you think? Absolutely. How long would it give us control, George? All the way until the which Friday of January 2020? Third Friday of January 2020. Is that a long time in the future? It's a decent time in the future, right? Yeah, pretty far in the future. During the time that you have control, do you think you could do something with the stock? And the answer is absolutely. So how much is it going to cost me to get control? If I want to buy the stock, it costs me $180 a share. If I want to buy the leaps option, it's going to cost me approximately $18 a share. And I'll have control for, according to this option chain, 521 days. Now, those numbers have changed just a little bit, but the principle is still the same. So for $18 a share, instead of 180, we have control for the next 18 months. What could we do with the QQQ if we had control for 18 months? Could you imagine, George, selling a 183 call option and bringing in a little bit of income? Ding, ding, ding. I could do it. Could you imagine turning around and doing it the next month? And could you do it the next month and the month after that and the next month after that? In other words, could we do the same thing that we do with a covered call, but instead of buying the call option, we buy the leaps position. Now we have control of the stock. Now if the stock goes up and we get called out at 183, we've already got the right to buy it at 180. So we actually have a $3 spread there. There's a profit, right? We're perfect. Nothing could possibly go wrong. Maybe. We'll talk about that in a minute. But do you understand this theory here? The theory is instead of buying the stock for 180, we're going to get control of the stock by buying a leaps position. Now we turn around and we sell that 183 call, bringing in about $1.40 over the next 29 days. And instead of spending $180, we only spent $18. Our ROI went from 0.7% to 7.7%. Ding, ding, ding. And could we do that every month? And could we use that $1.40 in August and September and October, November to lower our cost basis of our core position from $18 down to $16.60 and then ultimately $15.20 and then on and on? Could we do that? And the answer is yes, we could. What if we did this over the course of a year? If we run an average of 7.7% call premium at the end of the year, you've almost doubled your money with 92% recovery, $16,000, a $17,888 reduction. At the end of 18 months, you got a $7,200 real profit. You brought in $25,000, you got $7,200 real profit. That's assuming that the core position doesn't even go up. In other words, you've gained about 40%, about a 40% ROI. People say, well, how much can I make with calendar spreads? You know what? Every one of them is different. Every one of them is different. But assuming that the stock stayed the same price, assuming it stayed the exact same price and you brought in the same premium, $1.40 per month, in this particular example, you would have about a 40% ROI at the end of 18 months. Not too bad. Mic drop, please. Ding, ding, ding. Jason was really looking forward to the mic drop. I think I did a better job setting that up last time, right? That's pretty cool, right? 40% ROI, even if the stock doesn't move underneath it. Now, the major difference in the covered call and the calendar spread is this. The covered call will still have equity after 18 months, but the leaps position will not. After 18 months, if the stock price does not move, the covered call will still have equity in the stock position. After 18 months, if the stock does not move, the leaps position will not have equity. Maybe. Depends on how you positioned yourself to begin with. And this is the biggest difference in the covered call and the poor man's covered call. So here is the big warning, and you've got to understand this slide, folks. This is not a joke. I try to make light of it at times, but this one's really important. With the covered call, if the stock goes up and you get called out, you cannot lose money. With the calendar spread, if the stock goes up and you get called out, you can lose money. And I'm going to show you how. In theory, if you've got the right to buy at 180 and the stock goes up to 183, you're in the clear, right? You're in the green. You sell a 183 call, no big deal. Stock goes up. You made $1.40 plus you made $3 a share. That's in theory. But in practice, what actually happened is we spent $18 to buy that leaps position. You had zero intrinsic value. Now, if the stock goes up and you get called out, you're actually going to lose money. The reason is because you're only going to make $4.40 and it cost you $18. You tracking with me here? This is the biggest difference in the calendar spread and the covered call. Now, when you're dealing with a calendar spread, this is what your risk profile looks like. If it goes down, you're going to lose more money. If it goes up, you have a maximum reward that is equal to your strike price that you sold. Anything beyond that, you start to dip into your profits a little bit, but you're still making money. And everybody in my mastermind learned this one. Once you play with this, you're like, oh, there it goes, right? You get to about the strike price, 183 in this example, and your profits start to go down because your short call starts to cost you more to buy it back. So here's the rule. The rule is this. Here's how you avoid your risk. Buy to close your short option if the premium reaches 2x the premium that you received. Now, the reason we do this, a couple things. Number one, it limits your risk to 1-to-1. And then here's the other thing that happens. The underlying Leap's position will have gained enough intrinsic value to offset the loss of the buyback, making this somewhat break even. Now, I say somewhat. It depends. It depends. Let me show you an example here. We'll just go with QQQ because that's what we've been talking about. These are real numbers, and I'm going to pull up, if I can actually pull up a stock instead of a backslash. All right, so let's say that we come along here and we sell the November 16, which is going to expire in 8 days. Let's do this for a little longer out, maybe November 30. 2 or 3 weeks to expiration. And let's say that we sell the 176 strike price. Look over here at your delta. It's 44. You got a delta of 44. So if you receive $2.64 for this premium, which is $1.50 out of the money, $2.64 for that premium. Okay. Our buyback would be basically at $5, we'll call it. In order for the stock, in order for this to get up to $5, how far would the stock price have to go? Well, you're going to gain at 44 cents per dollar. So to get up another 250, you're going to have to go about $4 or $5. You're going to be up here at 178, 179. If the stock is up to 178, which is where your buyback point would be, how much is your long-term Leaps position going to be worth? Well, let's come down here. If we bought a 170, you've got a delta of 64. You see the difference? So this one, the 170 Leaps position is going to gain 20 cents per dollar faster. That's why I say it will offset in intrinsic value, and in fact, you'll actually be making money. And one of the adjustments that I'm going to make to this strategy after our mastermind, and you'll see this as we go a little further, is if you start in the money, if you go 2 or 3 strike prices in the money, like say you go down to the 165, which is $9 in the money, well, it costs you more, but half of this is already intrinsic value and you've got a higher delta. So it favors these buybacks and it makes it a little bit more friendly for the calendar spread, making it a little bit less risky there, if you will, in this particular scenario. So let me come back and I'll go through these slides one more time. Okay. So here's the risk of the calendar spread. The risk is if I sell a 183 call and I bring in my premium, 183 call, I own the right to buy it at 180, but I paid $18 a share for that. So if the stock goes up and I get called out at 183, great. I exercise my position. I buy it at 180. I made $3 plus I made my $1.40. I made $4.40. Yoo-hoo! So happy about my $4.40. Not happy about my slideshow and Apple, but I made $4.40. Problem is I spent $18. So I'm in the hole $14 approximately. Make sense? So here's where the value starts to go down. As the stock goes higher, stock price down here across the bottom, as the stock price goes higher, my profits are going to come down, which means about right in here, about 185. That's about what I drew out, right? A couple dollars in the money. You're going to want to buy to close the call. and you will turn around and sell to open another call higher. We'll talk about that more coming up in the next couple classes. Here's the rule. Buy to close the short option when you reach 2 times the premium you received. And again, the benefit is you're limiting your risk to 1-to-1 and you're offsetting because the underlying position is making more money. So in this example, if the stock increases, you're going to buy to close the short leg at 2 times the premium, which is $2.80. But you would have gained at least $2.80 in intrinsic value in the long leaps, and the value would have gone up by more than your delta. So you're still making money. Let me let that one sink in for a moment. This is where most people start to drown, gasping for air. Help, Jeremy, help. How you doing? Questions? Comments? Anybody? I can't imagine you don't have questions. It could just be that I've overwhelmed you, or it could just be that I explained it so clearly that you have no questions. Which one is it? Nicole, how are you doing? Barry, I knew somebody had a question. Barry, what happens if you buy the in-the-money leaps and the short call is assigned? Could you exercise the long leaps? Yes, you can always exercise the position. Question is if you'll make any money on it, Barry. Now, Barry, you've also presupposed something, and I appreciate you bringing this up because a lot of people make this presupposition. That is, I'm going to get assigned. I got 25 people here tonight, or roughly 25 people that were part of my mastermind. Did any of you get assigned a short call in the last 3 months? Probably none of you. Nobody reported it. Nobody. Because guys, look, here's what happens. You get into the money, 50 cents, $1. They don't assign it immediately. They don't do it. So people freak out about this idea that, oh, I'm in the money, they're going to assign me. No, they're not. Did you realize there's strategies of selling in the money options? Did you know some people actually sell in the money, deep in the money covered calls in a bear market, and they don't get assigned? Now, that's not to say that they couldn't, because they could, but they probably are not going to. So a lot of this, Barry, a lot of people really freak out about, oh my goodness, I'm in the money, I'm in the money 10 cents. What should I do? You should do nothing. Follow your trading plan. See what I'm saying, Barry? Now, if you do get deep in the money, or if you get into the money and you get assigned the position and you have the leaps, yes, you can exercise the leaps and you can use that to fulfill your position. So you're not taking on new risk. You're not taking on unlimited risk, but don't freak out about it, because the truth is you can usually make adjustments. And that adjustment looks a lot like you buy to close the short position and you turn around and you sell to open another one a couple of strike prices higher. That's exactly how it looks. All right. That help you out there, Barry? You're welcome, my friend. All right, let's talk about weekly or monthly. How do you want to get paid? Well, it's a great question. How would you like to get paid? You could sell these with weekly options. You can sell them with monthly options. Frankly, you can go further out. You can do this however you want to. The top chain here, you see weekly, the premium is about 28 cents. If you go out here to a month out, we were able to get closer to $1.40 or beyond. The difference is how much time you're obligated. That's the big difference here. There's not a right or wrong. However, what you're going to find, especially on most of these trades, to get that $1.40 premium, you're going to be pretty close to at the money. Maybe $2 or $3 out. Well, the stock may move that far in 1 or 2 days. So you find yourself doing a lot of buy to close. And what we found in our mastermind is the shorter term, we can collect that premium faster. In fact, we figured out one strategy where we do it every other day. And that works out really quite well if you kind of time it just right. So I generally have been gravitating towards the shorter time frames, but that does take a little bit more management. So there's not a right or wrong. You just get to decide how you wish to do it. The 1 week option pays less, even if you do it during the month, but you have less obligation and you have a lot more opportunity to fine tune it for maximum intrinsic gain, especially during a bull market, which means you make more adjustments and make more money. That's the key there on the weekly versus monthly. How do I figure out my ROI? ROI is really simple. Profit divided by capital. Profit divided by capital. Now, the calendar spread is a little bit challenging because there are so many moving parts. And honestly, guys, I'm just going to be transparent. What we learned, the good, the bad, and the ugly from our mastermind, this was the hardest thing right here, is figuring out how to factor all the moving parts for the ROIs. It really became challenging. You got a lot of moving parts. One moving part is the cash flow from selling. One moving part is the gain from the underlying increase in the leaps position or decrease. And then the other moving part is you have time decay of the leaps position. So you have all these different moving parts in there, and it becomes a little bit challenging. And then when you add the hedge, which is another part I haven't even talked about yet, that's even more challenging. So here's how we do the cash flow, and here's how you can think through it. And then maybe one of you comes up with the genius spreadsheet. We're working on putting together a spreadsheet that makes this easy. Premium received divided by your leaps cost, that equals your cash flow. That's month-to-month cash flow. Okay, so if you brought in $1.40, you're making 7% for that particular month. And then every time you sell, your ROI keeps going higher and higher. So what we found during October, since we started doing these in September, we had drawdown on our core positions during October, but we didn't lose nearly as much as it looked like we were losing because we'd had several months, or 2 or 3 weeks, I should say, worth of premium collected. So what happens is that first month you recover 7%. Well, it depends on the trade you're doing, but you recover in this example about 7%. Well, the next time you turn around, you do that again, you recover another 7%. So you can actually have a 7% hit to your position, and you're actually still at break even after that first month. So every time you sell, your ROI actually goes up. And then if the underlying increases, then your intrinsic value increases and your ROI is going up even more. Okay, so your profit divided by your leaps cost, that's your percentage gain. If your current price is 23, your original price was 18, you got a $4 gain, and you guys can kind of factor that all in there. So how much will the leap gain or lose? Well, that is a $1 million question. It's hard to say. It's a function of the underlying stock versus the time decay. And it's, I don't want to say it's impossible, but it's darn near impossible to forecast that. So what you have to do is assume that you've got these two moving parts, which you're dealing with all options anyway, but you got these two moving parts, right? So for example, on this screen, what you see, the dotted line shows if the stock were to go up immediately. So if the stock were to go from 180 immediately to, say, 195, our profit on that would be, on this trade, about $1,000. If it did that, if it went to 195 at expiration, which is a year from now, we would actually be losing 250. See the difference? So it's all a function of time. The dotted line is zero time to expiration, is immediately, so no time decay. The solid line is if you held it all the way to expiration. So at expiration, you need this trade to be at least $18 in the money. That offsets all of your premium. That's how you break even at expiration. That makes sense? And then, of course, implied volatility and other things can factor in there as well. Over the next 6 months, if the stock does not change, based on the theta that we've got, which right now you've got a long time, so you're very low theta. Over the next 6 months, if the stock does not change price, you'll lose about $4 of premium over 6 months, which represents about 22%. So you're fighting the 22% time decay. Over 6 months, you will time decay 22% of this option premium. Now, if you're bringing in 7%, multiply 7 times 6, that's 42. You've offset at a factor of 2. So you're making 20% profit while you're making 42% profit while you've lost 22%. Now you've got about a 20% difference. Over 12 months, you've lost about $10 of premium which is about half. But if you brought in 7%, you're what, 97% or something like that, 98%. So you're still making money over time. So you got these multiple factors that are working. That's why I said this is a complex strategy. So now here's the $1 million question. What are the odds that the Qs are not going to change price? And the answer is 0. I mean, who experienced it? My mastermind. We were in this trade, right? Who experienced this? I mean, this thing was just humming along great, making all this money. And then suddenly we have October. So guys, the price is going to change. That's the reality. And it's either going to go up or it's going to go down. And if it goes down, we've got some adjustments that we're going to teach you to make on this. If it goes up, we've got adjustments to make. And that's the cool thing. And maybe I don't want to say frustrating. I mean, in a perfect world, maybe the stock would never change price and we could just sit here and print money. That'd be amazing. But it's not reality. And the reality is if the stock goes up, we can make a lot more money if the stock goes up. So we're playing with all these moving factors, and you're kind of just timing the trades depending on what the current state of the market is. Tracking with me here? So what happens is if the market's going up like we had between May and September, we keep raising the strike price that we're selling calls at. And if the market's coming down, then you end up lowering it until you get to the point where it would turn it into a credit spread, which we're not going to address right now. But what we do for this, and all of my mastermind students experience this is what we have the hedge for. That's what we're going to talk about in the next class. And the hedge makes sure that we're not losing our shirt on this trade. Okay, so the reality is, folks, there's just a lot of moving parts, and the odds are 0 that the Qs are not going to change price. It's possible, but there's a better chance that the Qs are going to change price than they're not. And the reality is there's a better chance that they're going to go up and down throughout the course of a year. So that's why we have to make adjustments along the way. So we take a position and then we start to trade it, okay? Now, for just a hypothetical example, a year ago, if you had bought the 145 leap, which is where we were last October, you would have spent $12 a share. I went back and looked at the math. With 0 intrinsic value. And here we were by September, there it was. Went back and looked at it. And by September, August, when I did this slideshow, you would have had $35 intrinsic value plus all the premium you received. And the odds are that's probably what's going to happen again. You know, the odds that you're going to have a 10% sell-off in February, a 10% sell-off in October, and a market collapse next year, pretty low. Just really pretty low. It's probably not going to happen. My hunch is between now and next year, we're going to see the Qs go up. Maybe not all stocks do that, but the point is that stocks don't stay stagnant most of the time. All right, so I just told you a lot. I just dumped a ton of information just there in the last 10 minutes. Let that sink in a little bit. I will unpack more of it in the next coming couple of classes. Tonight, what I want you to do is review this, start practicing it, and show up Tuesday night because we're going to start teaching you about the hedge and whatnot. And then class 4, I'll teach you these adjustments, and we'll start to dig through some of that as well. All right, so there's just, I know this is a ton of information. What questions do I have right now? I kind of went rogue. When I get off my slides, I have a tendency to start injecting tons of information, and sometimes that's too much. What questions do I have to keep you guys focused and help you assimilate this tonight? Jason says, I have some about a collar, but I can wait to do that on Tuesday. Jason, I'm going to give you a minute and a half worth of collar attention. I don't know why you're obsessed about collars right now, but ask your question. George says he needs to think about it until Tuesday. Great. Hey, guys, these videos are already posted in your membership area for my last teaching. And some of you who took it the first time, do you think this is a better teaching? Should I replace those videos? If so, I can do that. But we do have videos, so you can review these videos. Nicole says, when we sell the covered call, we just pick any strike price out of the money, or should we look at the chart and see where the resistance is? Great question, Nicole. Nicole, you can do either way, first of all, but what's more practical is to look at kind of the best cash flow for your position. So if you go all the way to the next resistance, you may only get 10 cents premium and it may not be worth it for you. So you may choose to do a little closer to at the money, but be prepared to buy it back if you want to. Dan and George both say replace the videos. Okay, so this is a better teaching. Good. All right, good to know. TR says, after 12 months, we roll the leap. Will we be able to sell the leap 35 in the money? Yes. Or you exercise it if you have to. The mic drop was better the first go around. Sorry about that. Jason, what was your question about collars? Ask me your collar question. Okay, the good thing about the collar is you don't have to hold it for 18 months. Like the leap. You don't have to hold the leap for 18 months, Jason. If you exercise the put, you would just get the chance to buy the stock at a lower price and start all over again. You can do the same thing with the leaps, Jason. Cover calls every month and dividends can eventually pay the put that you bought several months out. You can do the exact same thing with this, Jason. There's not, like, I'm not poo-pooing the collar. And I'm not poo-pooing the collar at all. But there's nothing that you just wrote in there that made the collar premier to the leaps. What I'm teaching you here with the leaps is the poor man's supercharged collar. And now Jason has added, what I'm saying is that the collar is a solution for those who feel this is too difficult. Yes, you are correct. But we haven't even got that far, Jason. I haven't even talked about puts yet. I'm talking about covered calls tonight. And the answer is, if this calendar spread that I started laying out tonight with the leaps is too complicated, then what you do is you revert to the covered call. That's really what we should be saying. All right. Did you have a question about collars, Jason, or you just had some thoughts on collars to add in there? Any other questions? What other questions do I have tonight? David Ward, how you doing with your questions? Those of you who've been through my mastermind and you're coming back through this, I know I already saw Daryl say he's got some new distinctions just watching this again, even though he just spent the last month studying it with me. How are you guys doing? Making any new notes, any new questions? Yaz, how are you doing? Hadn't heard from you, Yaz. Cheryl, how are you doing? Ron, what you got going on? Lori, Linda, how you doing? Linda, you tracking with some of this? Yaz is doing great. George, how's it all coming together for you here? Cecil, I saw a video on YouTube that I thought of you. I need to remember to send it to you. George says he's doing great, but he's slow. George, what's you got any questions in there, George? You just need to let it marinate a little bit. I understand you guys if you need to let these things marinate. Look, I didn't dream this thing up in an afternoon. I spent weeks thinking through this, and then it even took the mastermind and the next 8 weeks of working this together to come up with some of the revisions that I'm now adding. Oh, thank you, Dan. He says every time he listens to me, he learns something new. Well, Dan, I'm going to send you a special T-shirt for Christmas. By the way, is Mark Hutchison here? Mark Hutchison, are you here tonight? I don't see him. I won't give him my compliment if he's not here. Linda said she has a question. Go ahead, Linda. George says, seeing the difference on buying a call versus selling a put and selling a call versus buying a put or buying, yeah. George, you're not understanding the difference of why you would buy a call as opposed to sell a put? All right, George, if you're there, don't execute this strategy yet. We need to go back to some basics for you. You've been through foundations, right? And it's okay, George. I mean, I'm not in any way being critical. I'm just saying, hey, let's come back to basics. Let's make sure you got that one down. I don't want you to take on a complex strategy like this before you've really understood those ins and outs. It's really, really important. This is about as complex of an option strategy as we can put together. Okay, George, if you got any questions on that, George, send an email to info@tradesmartu.com and let's try to get some help for you on that because I don't want you confused. I want to help you out. By the way, guys, some of you have complained that you have not gotten timely responses from emails from me. Look, there's a reason. I have 39,170 emails that are unopened in my email box. I love you guys, but there's a really good chance if you send me an email, I don't see it. Others of you have sent me emails and they are not short and sweet and to the point, and I do see them, but if it's going to take me an hour to answer it, I'm not going to answer your email. Again, it's nothing personal. I just don't have time to get it answered. Send your emails to info@tradesmartu.com. And if it needs my attention, Rebecca will get me on the phone or whatever we have to do to get an answer for you. But please don't send emails to Jeremy@TradeSmartU, especially if they're long, and expect a response in the next, few hours. It's just, and to top it off, despite the fact, or in addition to the fact I got so many that are in here that clutter it all up, I only check my email account like once a day. I mean, I don't stay on email very much. So, and I do that because otherwise I spend my whole time on email. So I pay Rebecca to answer emails. I pay her to sit there, and when your emails come in, if she's there, she will answer it quickly. If she's not, it will be done within 24 hours or so. And if it really needs my attention, then she'll make it known to me. But otherwise, I would be nothing more than an email answerer. And I know you guys can appreciate that. So please help me out on that. And that way we can try to, triage your emails and we don't get on attention needs to be clear action. I don't want to expect, and I want to